I know that when you're buying a house, it could be overwhelming with all the mortgage payments, interest rates, stress test, and all the questions that you get asked when you're thinking about buying a house. But it's very simple, actually simpler than that. Our clients usually ask us, Bridget, how do mortgage payments work? Great question. First thing first, a mortgage, in simple terms, is a loan from a lender. It can be a bank, credit union, or a private lender. So you would get a mortgage in order to buy a home, and you would borrow the money from the lender. And what you would be paying is the principal, so the amount of money that you borrowed, and interest, which is the fee that you pay the lender in order to borrow this money. Now, here's the tricky part. At the beginning, when you're making mortgage payments, most of the money will go into interest, so to the fee that the lender is charging you for lending you this money. And why is that? Well, it comes down to something called mortgage amortization. When you first start paying for your mortgage payments, the first amount goes towards your interest. And the reason why is because the amount you borrow is still high. So most of the payments will be going to interest. But as time goes by and that amount decreases, your mortgage payments will be going more towards your principal. So towards more your home, towards to building equity for you. So let's say, for example, you take out a mortgage for $360,000 at a fixed rate mortgage of 5% interest rate for 25 years amortization. Your monthly payment would be around $2,093. In your first payment, about $1,485 would go to the bank, to your credit union, to whoever lent you the money. And only $609 goes towards the principal. So this would be paying down the amount of the money you borrowed. After 25 years of paying off your mortgage, on your last payment, only $8.60 goes towards interest, and the rest pays off your home. So when do you start paying less towards interest and more to principal? That's called the tipping point. Depending on your loan terms, this might happen after several years of payments. There are 3 things that we can do to pay off our mortgage faster or reach that tipping point quicker. Number 1, increase monthly mortgage payments. Or you can make extra monthly payments towards your mortgage. But with these 2 things, we have to be careful because once we contact our lender saying to them that we want to increase our monthly payments or we want to make extra monthly payments to reduce amortization, then that means you have changed the term and then they'll be expecting this increase amount month after month. So if you are going to change something in your term, like increasing payments or making extra monthly payments, make sure you're able to do this through the whole term of your mortgage. The next thing that we can do is that we can make lump sum payments yearly. And this varies based on your mortgage terms. And it can be anywhere from 15% to 30%. And this will be more convenient than the other 2 options we had. If your mortgage term allows you to pay 15% of lump sum payment every year, and let's say you saved money or you received a bonus or you got an increase in your job and you have extra money to pay off your mortgage, you're free to do it whenever you can. The banks are not going to expect you to do this year after year. Assess your situations and see which ones work for you. Now, if you have a variable rate mortgage with fixed payments, there's another important term to know: the trigger rate. This is the point where your entire payment only covers interest and nothing goes into your principal. If interest rates rise, and we've seen that throughout 2024, and you hit your trigger rate, you may need to increase your payments to avoid negative amortization, where your mortgage balance grows because nothing is going to principal and everything's going to interest. Now, let's say if things get worse, where we sign 2024, month after month, increase after increase, you might hit that trigger point where your loan balance exceeds the original mortgage amount. If that happens, you'll need to renegotiate with your lender, make a lump sum payment, or refinance your mortgage. So how do we calculate a mortgage trigger rate? Your trigger rate is usually listed in your mortgage contract, but here's a simple way to calculate it yourself. Multiply your payment amount by the number of payments per year. Divide by your remaining balance and multiply by 100. $1,184 times 26 divided by $580,000 times 100 equals 5.35%. If you're concerned about rising interest rates, use our calculators to see how they could affect your payments. Planning ahead can save thousands of dollars. This trigger rate only kicks in if you have a variable rate mortgage. Now, if you want to learn the difference between a fixed rate mortgage and a variable rate mortgage, I created a video for that. Click on the link below to watch it. To learn more about mortgages and how mortgage payments work, contact one of our GT Homes agents today.